everybody, this is Pavitra, Assistant Professor, Department of ECE, Kongu Engineering College, Perundurai, Erode, and I'm going to convey on a topic break-even analysis in engineering, economics and management. And break-even analysis is otherwise termed as cost-benefit analysis or cost-volume profit analysis. And it is an analysis of break-even point. Break-even point is nothing but a no profit or no loss point. And it is also defined as an analysis of cost and their possible impact on revenues and volume of the firm. And the break-even point, which is termed as BEP, which is shortly termed as BEP, can be determined only when we equate the total revenue to the total cost. And there are some assumptions underlying this break-even analysis. And first assumption is the cost cannot be perfectly classified into fixed and variable cost. This is a common point, but here the first assumption is we have to consider that cost can be perfectly classified into two costs, which is termed as fixed and variable cost. Selling price does not change with the volume changes. That is, no price discounts will be entertained while formulating this break-even analysis. But in real time, the selling price will change due to some discounts or clearance sale, etc. Because, for example, if you're selling any product, the first year of that selling price will not be the same as the years passed by later, that is second year or third year, due to the some reasons like a clearance sale or discounts will be given on festival times. For that reason, selling price cannot be the same, but here we are assuming that selling price is not changing with volume as the volume changes. And here another assumption is that all goods produced is assumed to be sold. That is, no closing stock. Whatever we are producing, we are assuming that all products we are selling. Then only we can able to formulate that BEP, which is termed as a break-even point. And then fourth important assumption is that we are considering only one product which is available for sale, and no multi-product will be entertained while formulating this break-even analysis. And these are the four important assumptions. Recalling that, first, we are assuming that cost can be perfectly classified into fixed and variable cost. And second one, selling price is not going to change as the volume changes or other parameters like discounts or clearance sales. And third one is whatever the goods produced will be sold. And the fourth one is only one product we are taking into account for formulating this break-even analysis, and no multi-product will be entertained for formulating this break-even analysis. And coming to the key terms in break-even analysis, I already told that break-even analysis, otherwise termed as cost-benefit analysis. That is an analysis of cost and their possible impact on revenues and volume of the firm. And BEP is termed as, that is, break-even point is a point where no loss or no profit is achieved at that particular point. And we already termed the cost as fixed cost and variable cost. Fixed cost is nothing but in any business or firm, there will be some cost called fixed. That is the building rent, property taxes. The cost remain constant throughout your whole business journey or industrial journey. Example for that is building rent, property taxes, and equipment cost. Once the equipment purchase, that cost will going to remain the same for all the coming years. And next is fixed overhead, insurance cost. Once the insurance is developed, and it is going to, that percentage will be going to retain throughout your whole business period, whether it is a 10 years or 20 years, etc. And minimum workforce cost, that is labor cost, that is basic pay cost. And the second cost is a variable cost. Here the cost will change with the real-time parameters such as production level and workforce size. For example, if you are starting a business and running it, and for first year you are hiring some 100 employees, and for the second year you are going to hire the 200 employees, 300 employees, because you are going to enhance your business in order to get more profit. So for that reason, that parameters will going to change. So that cost will comes into the variable cost. And the labors, For example, incentive has been given to the labor year by year with some percentage, some bonus will be given for festival times and all. So for that, cost and all will vary and it can't be fixed, and it will not come under this fixed cost. Fixed labor, material cost, raw material cost will vary depending on time to time, and marketing cost. And these are all the examples for variable cost. And the total cost of any business or industry or firm will be assumed here as the sum of the fixed cost and the variable cost. That is, total cost TZ is equal to fixed cost FC plus variable cost VC. And here the revenue is nothing but it is termed by the notated by the letter R, the total revenue. That is, revenue is the total amount you are getting out of some quantity sold. For example, if you are producing 100 products within a year, assume that you are running one business and you are going to produce 100 products a year, and the total revenue is the 100 products into your selling price will be your total revenue generator, total amount generator. For example, per product you are selecting the amount as 100 and totally 100 products are there. So total revenue generated will be 10,000 out of that 1 year. So that is your total revenue and it is denoted as R. And next one, profit. Profit is nothing but your revenue minus total cost will give you the profit. Revenues, the total amount you are getting out of your total product sold minus total cost is your total spent cost, that is raw material cost, labor cost, etc. we will minus, and the remaining cost will be your profit. In any business or firms, this is the actual formula, that is profit is equal to the total revenue generated minus your total cost. And this total cost, again we have formulated it as fixed cost plus variable cost. So profit can also be determined by subtracting the revenue, subtracting fixed cost plus variable cost from the revenue. And this is one example for a single product break-even chart. That is, we are going to draw a chart taking the quantity sold in the x-axis and the price along the y-axis. Here, the total cost is a straight line starting from here to here, and the total revenue is again a straight line, and where the total cost line and the total revenue line touches, that point is called break-even point. That point is called no loss or no profit point. So this point can be formulated only if you assume that total revenue is equal to total cost. So above that point you are going to get the profit, and below that point you are going to get the loss. So before taking any decisions in business or before investing any amount in business, if we analyze or if we put this break-even analysis, means we can easily able to determine at after which period the total amount we spend will be returned back to us, and after that we are going to get the profit. For example, if you are investing 1 lakh in a business, and if you are getting that 1 lakh after 6 months, means that 6 months is your break-even point, simply. And after that 6 months, whatever the amount you are getting will be your profit. And if that 1 lakh amount is not getting within that period, means you are not able to get throughout your business journey, means it is a loss point. So your business idea will go into a loss point. So we can able to change the decision or modify our decision to enhance our business. And there are also another key terms involved in this break-even analysis. The first one is contribution margin, which is nothing but it is the difference between the selling price per unit and the variable cost per unit. And another formula to calculate this contribution margin is fixed cost per unit plus profit per unit. And here the profit can also be calculated as the difference of contribution and the fixed cost. Contribution margin ratio is another key term, which is nothing but it is a ratio between this contribution margin per unit and the selling price per unit. And next important term is margin of safety in units, which is determined by subtracting the break-even point in units from the excess of actual sales in units. And next one is the margin of safety in sales volume, and it is determined by subtracting, or it is taken as the difference between the excess of actual sales in rupees and the break-even point in rupees. And next is P by V ratio. It is an important key term. It is determined by the ratio of contribution and sales. That is, contribution divided by sales will give us the P by V ratio. And these are the formulas. The first is the selling price can be determined with the help of the two cost and profit. That is, addition of fixed cost plus variable cost plus profit will give you the selling price. And the addition of fixed cost plus variable cost alone will give you the total cost TC. And the selling price minus now the variable cost will give us the fixed cost plus profit, which is equal to contribution. So contribution can be determined by subtracting the selling price minus the variable cost. Next comes the contribution per unit, which is equal to the selling price per unit minus the variable cost per unit. So per unit or per sales will be the same for all formulas. These are the important formulas in formulating this break-even point, which will be helpful for the break-even analysis. And a BEP in units is determined by dividing the fixed cost, which is nothing but FC divided by the contribution margin per unit, and BEP, that is break-even point in value, is determined by dividing the fixed cost divided by contribution margin ratio. And next, profit by volume ratio is termed as the division of contribution by sales, and BEP in terms of P by V ratio is given by fixed cost divided by P by V ratio, and margin of safety in terms of P by V ratio is given by dividing the profit by P by V ratio. And another important formula to calculate the volume of sales to attain a targeted profit is fixed cost plus targeted profit divided by contribution margin. So whatever the parameters you are having, if we substitute in these formulas, we will get the desired output. So these are some of the applications of BEP, where mainly the break-even analysis is useful for make or buy decision, whether we can able to invest, or whether we can buy a product, or whether we can buy a company or firm or industry by putting some shares or some amount like that. We will calculate the payback period, and with the help of this we can able to take a wise decision. And next is by choosing a product mix when there is a limiting factor, and drop or add decisions. These are all some applications of break-even analysis, and the importance or significance of break-even analysis are to assign the profit on a particular level of sales volume or a given capacity of production, and to calculate the sales required to earn a particular level of profit, and that is before investing a particular amount. At what period we are returning back that amount will be determined with the help of only this break-even analysis in economics. And to compare the product lines, sales area, methods of sale for an individual company, and to compare the efficiency of the different firms. That is, if we invest in this firm, or if we invest a share in one particular firm, what is the payback period is what, and the second firm, what is the payback period. Like that we can able to analyze, and we can make a wise decision of to which firm we have to select and invest, so that we can able to get the more profit. For this analysis, this break-even analysis is very much helpful. And there are also some of the limitations of break-even analysis. At the first assumptions, we have assumed that the BEP is calculated and the cost will be divided only into fixed and variable cost. But in real time, that BEP is not only based on fixed and variable cost, and also there are total revenue, and if any one variable changes, the all other variables are going to change. But we assume that there will be no change in another variables. So while implementing it in real time, some changes will be happen. That is, if with the help of this break-even analysis, if we calculate that within 1 year of time, we are getting back the amount invested. But in real time, due to some changes in the variables, we will not be able to get that revenue in the that is a profit or the amount invested within 1 year. It may take 2 year or 3 year due to the change in variables. If the variable doesn't change, no problem, but in real time there may be a chance that any of the variables may change due to natural calamities or disaster situations or etc., or due to the taste in the customer change or market change. And the second limitation is all cost cannot be classified into fixed and variable cost. There may be some other cost also in real time. And here we are taking and analyzing only for a single product, but there are so many firms which are following a multi-product brands and they are selling that. So in for that kind of firms we can't able to analyze using this break-even analysis. So for that series of charts will be required, and we can't able to determine the exact point of time where the total amount invested will be get back. And here the fixed cost concept doesn't hold good for short run case, holds good only for short run cases and doesn't hold good for long run cases, because the fixed cost may change or may vary for a long run basis. And here total cost and total revenue is not always a straight line. In the chart we have seen that the total cost curve is a straight line and total revenue is a straight line, but in real time there may be deviations up and down is there. So if in that case we can't able to determine the exact break even point, even though if we assume that total revenue is equal to total cost. So that is one of the limitations of break even analysis. And here all the business conditions are volatile, and the BEP can't be or can't give the stable results all the time. It may vary and it may volatile as business trend is changing from time to time. Thank you all.